Okay. Hi, everybody. It's Tim and Billy
Right.
back in 2023 to provide some insights on the markets, which have started very, very well in January and year to date as well. Um, but obviously more optimism on the rate hiking cycle being over. So I think today we will just give you a short overview of where we stand with the Fed, what markets have been doing on the earnings side with big tech, and then a quick look at Singapore. So Billy, to start off, what's your thoughts on the FOMC meeting last week where the 25 basis point hike, came through? I think it was expected. What really stood out for you from the meeting? What did you take away from it?
I think a lot of people are very happy with the fact that the Fed is talking about the disinflation rather than so that gives the market a bit of optimism that the Fed rate hike will take a back seat this year. But I guess what the important thing that we can see is, I think towards the end of last year, we talked about whether it will be a bull or bear market this year. And it just shows how quickly the market can change based on what the policymakers are saying and doing. And I think this is something that we all really need to, I mean, we've talked about it that, it's the Fed's policy that will be directing the market again. And it just shows, right, that any sign of slowdown in the pace of the rate hike, then you see the market rally. I mean, of course, I think we are not at the, we are not over with this yet. I think there were some talks that, it could go up to 5.25% or, or so. So I don't think we are out of the woods yet, but it shows that, the Fed is ready to, to talk about whether to slow down the rate hike that they have been doing over the last 4 quarters. I think they've been doing it for like seven. Yeah. So that's something that's positive for the market.
Yeah, no, I think what you spoke about on disinflation was interesting because I saw that he mentioned disinflation or he used that term 11 times in the meeting
Yeah.
in his comments. And I think the market really took off after he started talking about disinflation because the market rallied obviously after the meeting and his comments, but it really took off after disinflation was used because I think the market is now thinking that this is the end or there's going to be one more hike, and then this will be the end. But then last Friday we had that jobs report with 517,000 added, which was way above 100. I think it was the estimate was 180,000, so it was a blowout report, right? It's nearly triple what was expected.
Yeah.
uh, I think it's going to make it really difficult for the Fed to manage that from the hot jobs market, super tight jobs market, which is shows that the US economy is still doing very, very well. So I think there is some doubt maybe from some corners of the market whether this is going to be the last rate hike, in March, or if maybe there's going to be one more after that as well. But you're right. I think it's been a lot more dependent on the Fed thinking it's coming, or everyone thinking the Fed's coming to an end, right? We've seen growth stocks rally really, really hard this year so far. I mean, some of the even big like tech names like Nvidia is up 50, 60%. These are really big companies. So
Yeah.
interesting to see that. But I mean, I think if we think about the market and if we move to earnings, how did the earnings outlook look for you, or how did it play out for big tech in the past couple of weeks? Because we had Amazon, we had Apple, we had Microsoft, and then we had Google as well, Alphabet rather, report, right? So I mean, what were your takeaways from that whole series of earnings releases?
I guess overall is an underperformance for the big tech in the sense that they fail to meet expectations and and I think and it's probably cut some of their earnings forecast as well. But I think in a sense it is in line with what we've been talking about, that the rate hikes that we've seen over the last 1 year or so, the impact of it we are starting to see it. So for example, if you look at earnings, right, I think most of the earnings that Microsoft or Apple and likes are mainly affected by the strong dollar, which is also driven by the rate hikes in the United States. So I think that those are part of the reasons that have affected earnings. And I think we've seen a lot of layoffs in the tech companies. And I think if you talk about recessions, I guess we will be seeing a recessions for the knowledge workers, those in the tech, those in the high, finance maybe as well. So it's not so much as I don't think if you're seeing a broad-based recession, given what we've seen in the jobs reports, but I do think that there is a concern on that front because the fact that they are cutting, it means that they are anticipating some form of slowdown. So I think at this point, only Apple has not cut, right? If I'm correct.
I think Apple's the only one, right? Because
Yeah.
Microsoft announced some big job cuts, and then even had something, I think Zoom yesterday announced 15% as well. So I think a lot of tech firms are cutting, but from big tech, Apple's the only one that has not cut. But I think there is a, sort of unofficial hiring freeze at Apple at this point in time, which is not a surprise.
Yeah. But I guess it's in a sense expected that, given what we've seen over the last 1 year, the impact is going to be either this quarter or the next, where we see that sort of slowdown.
Yeah.
And I guess in the near term, we should still see that sort of challenges, especially in terms of the financial performance. But on the longer term basis, I do think that a lot of these tech players are in a very good position to, drive growth. I think you look at a lot of mention, not just the big tech, like even Nintendo, they have been doing very well over the last 2 years. So recently, I think their earnings they also reported quite a big drop because of the demand for Switch and all that. I think it's basically the normalizations of what we have experienced over the last few years. Things have been growing so fast, and we are now hitting a point where things are just gonna take a bit of back seats, from what we've seen over the last few years.
Yeah, that's true. I think there was a bit more optimism around the fact that they're starting to cut. I think there's always a cut staff or cut numbers because there's always worries about margin, and I think investors are worried about margin and
Yeah.
it falling with revenue growth slowing so hard. I think the revenue growth is an issue that has really affected all the big tech players. But I think overall the earnings season so far has pretty much gone to expectations, right? I think it's slowing. I think analysts' consensus expectations probably still too high for this year
Yeah.
for the S&P 500. But if we think about Singapore and REITs, we've started the earnings season in REITs. I think what I found really interesting about the REITs is that, I mean, they've rallied again also this year because of the optimism around the Fed, and obviously REITs we know are impacted negatively by higher rates because
Yeah.
funding becomes more expensive and debt becomes more expensive, and REITs generate their growth off debt and off the cost of debt, right? So that's one of the reasons why REITs were so underperformed in 2022, but they've done relatively well so far in 2023. But Singapore REITs have really held up well in terms of their debt maturity profiles, in terms of their capital management. I think that's something that has been really positive. But I think maybe this year there might be a bit more scope for acquisition if there's a bit more stability or visibility on rate hikes and where it's going to settle. But I think the main concern for investors is probably whether rates are going to stay high or whether they're going to come down. I think that's a key question mark for investors, because if rates they pause, or the Fed pauses at 4.5%,
Yeah.
you really expect a cut, or you'd want a cut, right, into a recession, but maybe there won't be a cut for a while or into 2024. So I think investors expecting a cut in the second half of 2023 or the Fed to start cutting, in the second half is quite optimistic in my book. So I think we have to be a bit more careful about hoping that they start cutting there. But we saw a general slowdown in the growth of some of the bigger logistics and industrials DPUs, but the retail side was pretty positive, right? I think CapitaLand Integrated Commercial, which I just wrote about, increased their dividend by the DPU by 3% in the second half. And there were some other retail REITs that have done well, and office REITs as well that have done well, but they're all benefiting from the China reopening as well. So, I mean, where are you seeing opportunities in the REITs space, and what did you find interesting over the past few weeks from REITs earnings?
I think we've talked about retail and hospitality rate, the likes like CapitaLand Escort, for example. I think their dividend grew by about 50%.
Yeah.
So I think basically, like you said, the reopening of China will support these REITs. And I think that overall, most of Singapore REITs have done pretty, I would say, decent. And I think the key is to look at the management of their capital, how much the cost of debt has continued to, I mean, it will go up naturally, but you can see a lot of the players have managed to deal with the situation pretty decent. And I think that those are things that we need to look at when we consider it, because honestly, we can't really control in terms of the rate hikes, whether it's 2 times or 3 times, or whether they're going to cut, but I think we need to look on a bit on a longer term, especially if you're looking at REITs. I think some of the REITs players in Singapore has proven themselves. And of course, with the reopening in China, it's good to look into those that have that benefit. So, but overall, I'm quite happy with some of the REITs that, I mean, the yield that they have is also quite decent at this level. I
Yeah.
think most of it is at least, I think average is 6 to 7, right now.
Yeah, I think so. It's just over 6%. And the yield spread over the 10-year Singapore government bond is still pretty good at like 300 basis points or so. So there's still a pretty good yield spread over the, what you consider like a safe treasury asset in Singapore. So I think there's more confidence, at least with rate hikes slowing in the Singapore REIT sector, which is positive. But I think the expansion plans, maybe they will start to unfold in the second half of the year if there's a bit more visibility on when the Fed will stop, and if the Fed is stopped by then, which I assume it probably will. And then maybe they can think about acquiring. But the big REITs, I think, have got all the firepower and all the low cost of debt, so that's a positive for the larger cap REITs. And maybe some of these smaller cap REITs will have some trouble. But we've seen these REITs with overseas assets really have issues, right, with attracting investors,
Yeah.
and they've been hit hard. And things like Manulife US REIT, which has office assets in the US, which have suffered tremendously. I think they have more challenges ahead. But I think the big well-known REITs here that have really quality assets in Asia or in the US, in data centers or in logistics or in retail commercial, I think they should do okay this year.
Yeah, I think if you look at most of the guidance that provided, I think they are still quite positive on the rental reversion. I mean,
Yeah,
I'm guessing that we will see some impact for some of the offices REITs as well. I mean, in the longer term, and companies looking into remote working, hybrid, I think probably we could see some negative impact on that front.
right.
But I assume that, you look at, I mean, looking at how they've been managing their borrowing, the overall gearing level, how they actually manage the fixed debt proportions to the overall debt. I think those are some positive takeaway for investors who are looking to. I mean, I agree with you that there is a lot of uncertainties in the near term, but I
Mm.
don't think it's wise to just look at investing on a 1 year time
Yeah,
horizon. And I think this at this level, it does offer quite an attractive proposition for investors. So yeah.
yeah, yeah. No, certainly. I think the rental reversions are important. I think if they can beat the rate of inflation, then that
Yeah.
should offset the impact of higher rates, right? So I think it's more important that the assets that the REITs own are able to demand higher prices when they come up for renewal, and they have um, either CPI linked rental hikes, or they're able to demand the rates that are in line with inflation or higher. So, and I think there are many REITs that are still seeing pretty strong rental reversions in Singapore. So I think that's positive over the longer term.
Yeah.
And we all know that real estate is a solid, REITs are a pretty good solid asset to own in times of higher inflation, at least historically. So I wouldn't see that be sort of a reason not to own Singapore REITs in this sort of environment. So I agree as well. Yeah, I think that's pretty much it for us today. I think we've had a pretty good discussion on the roundup over the past sort of 4 or 5 weeks and what we've seen so far in 2023. And we will be back in a couple of weeks with another markets update and insights from myself and Billy. So thank you, Billy, for time today, and we will see everyone next time. Thank you, guys.
Thank you.
Yeah,
Bye.
buddy. Bye.